Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host, Joel Alcon, along with Dennis Dick, and we have Joe Saluzzi on the line. He is the partner and co-founder of Themis Trading, whatever you want to call it. Joe, I can't tell you how excited Dennis is when you're on the guest list. How you doing this morning?
I'm doing great. I don't know why that is, Dennis. I mean, we have some common ideas, common goals.
Because Joe gets it. He gets it. And you know what? We have interviewed probably 3 or 4 people on the flash crash of August 24th, and I get them on this show, and then they usually say, oh, no, it wasn't a flash crash. And then I argue with them for 5 minutes. But I knew Joe Saluzzi, he's coming on. Joe's going to say this was a flash crash. And we think it's a flash crash so much, Joe, that we've actually given it an acronym. And when we look at the charts, when we see the low, the big low on the charts for all these stocks, we see the low we call an FCL. That's the flash crash low. So we've even given it an acronym on the show here. So would you agree with us, Joe? Was this a flash crash?
Well, how could it be anything but a flash crash when you have ETFs that are trading over almost 50% below where they were the night before and way below the net asset value? When you have KKR trading at half of its price from the night before, when you have GE trading down 20% in a matter of minutes, how is that not a flash crash? That was a failure. It was a huge failure of market structure.
How does that happen?
How it happens is that what happens, everybody knows the events in the morning, right? The volatility, there was a lot of stuff going on overnight. But when you have no markets and when there are no bids and a market order comes in overnight, and let's just say some of the retail folks were nervous Sunday night and they saw that the market would be opening, lower. They put market orders in for the opening. Well, guess what? When they go hunting for a bid and there's no bid there, you get a flash crash. You get market moves that shouldn't be happening, particularly in the ETFs. And that to me, look, we've seen GE flash crash before. We've seen other stocks go down 20%, and we're kind of becoming numb to that. But when you get ETFs going down over 50%, that's a serious problem. And actually, there was a note yesterday by J.P. Morgan, and they actually quantified it. There was 290 ETFs that had bad prices, and the estimate that they put on it, listen to this number, $250 million in potential investor losses. Where did the money go? Where did the money go?
It went somewhere. People sold down there. There was some people selling down there, and obviously market making wasn't there on those, because you'd think these ETFs, there's underlying holdings there. So there should be like a pure arbitrage play there where you obviously sell the underlying holdings and buy the ETF and can scalp it out. But the market makers weren't there doing that because we don't have traditional market makers anymore. We got obviously a lot of algorithmic market makers. But when signs are troublesome and they don't know and they can't get the quote feeds or the speed of the market's a little bit too fast, then they back off the quotes. And basically that's what you had is like no bids on all these things.
Right. And part of the problem, and I kind of sympathize with them a little bit, is that the underlyings weren't opening. So if you don't know what the underlying brand, you had a Rule 48 out there, which made it more vague or more, or opaque as to what the prices were. So they couldn't figure out where to price these ETFs. So here's a suggestion. Don't open an ETF until all the underlyings are open. Wouldn't that be a simple process? That way you don't have these problems in the future. But obviously that would cause other issues, and that's not the solution they want. And you're hearing the industry crowd around, we need tighter limit up, limit down bands. That's not the issue here. The issue here is a market structure failure, how the bids and offers can just evaporate like that. So they need to figure out a better way. Well, if the underlyings are not open, well, then you can't trade the ETFs, because who's trading these ETFs? It's mostly retail. They're the ones getting hurt. The RIAs who are recommending them to the clients, they're the ones getting hurt here. This was not a professional. The professionals didn't get hurt on this one. It was the retail again, and $250 million is a heck of a lot of money.
The limit up, limit down, I just want to bring it back to that point here too, because a lot of people don't realize, but the limit up, limit down circuit breakers actually don't kick in till 15 minutes after the market open at 9:45. Why is it that, if they would have those things operating at 9:30, obviously some of the bands are 5%, 10%. We wouldn't see GE down 20%. We wouldn't see a lot of these different ETFs trading down 40 or 50% here. Why is it that they don't just bump that up and have those bands, I know it's just a Band-Aid solution, but why not have them operational at 9:30?
I don't know, and it took them years, to get the limit up down in place after the original flash crash of 2010. I don't know, but I still think that you're not like you just said, it's a Band-Aid fix to the real issue of what happened to liquidity. Liquidity, that term that we use all the time, it's not volume, right? Liquidity is different. Liquidity disappears on volatile days, it seems like. It seems very abundant when there's very slow days, and in the middle of the day at 11 o'clock, there's tons of stock to buy and sell. But when there's a volatile morning like that, and there's nothing going on, and there's a lot going on overnight, that liquidity disappeared. And I think that's the real problem here. You have to address what happened to the diversity of market participants.
Bingo.
Where are those real limit orders that used to be there? It's gone, right? You've addressed it with a fragmented mess of a maze of stock exchanges and dark pools. That's the theory. That's why we wrote a book called Broken Markets, because the issues is still, this is not how you're supposed to trade stocks. You lost your diversity. You lost that the aggregation of liquidity. So those are the real issues.
Yeah, and that is a major issue. And not that we're blaming high-frequency traders for this, but they seem to be our only liquidity providers here now. And if it's all high-frequency bids that don't have any affirmative obligations, when the going gets tough, you're left with these liquidity vacuums.
Right. I mean, listen, these guys are proprietary traders. I get it. And if I ran a proprietary trading book and I didn't know what the underlyings were trading at, well, why would you make a market? It doesn't make any sense. You're going to get run over. You're going to get crushed. You're probably going to exhaust your capital limits pretty quickly. That doesn't make any sense either. However, then don't open the stocks. Okay, there needs to be a better process, and I think KKR, as a matter of fact, there was an article a week ago. They were very upset about their stock, and the underlying the DMM there is a firm called IMC, which used to be the Goldman Sachs used to run that stock. Now IMC out of Chicago runs it, and apparently KKR is very upset, and they may want to change DMMs, according to the Wall Street Journal.
How do we get more diversity? Like, how do we get other traditional participants back providing liquidity so we're not so dependent on this high frequency liquidity? Like, what do we need to do to fix market structure to get institutions maybe to use a little more of the lit markets? Because we know a lot of institutions go off, exchange because, the lit markets seem to be toxic here. How do we get some traditional liquidity back into the markets?
Well, the first thing, and this we've been saying forever, the first thing and the simplest, or the most obvious thing to us is get rid of the payment for order flow systems that are out there. Get rid of the rebates, get rid of the payments that the internalizers pay for retail flow, where they're siphoning off before it gets to an exchange. So, for instance, if a retail order wants to, sell 500 shares at the market, that order never makes it to a lit exchange. That order is getting siphoned off by an internalizer who's paying for that flow so they can model it. That order should be getting to a lit exchange. And if it did, that may encourage more liquidity providers to put a visible quote out, because then they feel like, if I'm the quote setter, I'm going to be rewarded for setting the price because I will get the trade. As opposed to now, if I'm the quote setter, I don't get anything because I know an internalizer is either going to jump in front of me if that sell order comes in, or even worse, they'll just penny jump me and post a bid higher. So get rid of payment for order flow. Like I said, there's two types. There's with the internalizer, but then there's also the rebates that exchanges have been paying for years now, which amounts to hundreds of millions of dollars for retail firms and others. You don't need payment for order flow. You don't need rebates. All it does is distort pricing. So if you did that, that would be the first step, and it would be actually the biggest step in order to get some of this flow back on these lit markets.
We're on the line with Joe Saluzzi. He's a partner and co-founder of Themis Trading, joining us here on Benzinga's Pre-Market Prep. Joe, you used a term there. Dennis and I are familiar with it, but just for people newer to the markets, lit exchange. Will you add some color to that?
Sure. I mean, right now there's 11 pending at 12th, I believe, visible lit exchanges, right? So those are your traditional ones, like, New York Stock Exchange owns 3 exchanges, NASDAQ has 3 exchanges, BATS has 4 exchanges. Okay, these are, those are the 3 families, as we call them. So those are lit venues that you'll show your visible quotes, so that when you look on a montage or quote montage, you'll see various quotes, and those are the ones. However, there's also 40 other or so dark pools that are operating within those lit exchanges, or outside of those lit exchanges, rather, that have their own quotes that are usually being pegged off of those lit quotes. So you have 11 different venues showing prices, bids and offers, and most of the time those bids and offers are very small. So very rarely, the average trade size is less than 200 shares on a lit exchange, as well as the dark pool, by the way. So lit exchanges are simply just visible exchanges, traditional ones.
And, you were talking about the activity, how the retail, really got stung on that with the sell stops and the orders. You deal with institutional traders, institutional investors. I mean, how were they? Were they pretty calm, cool, and collecting in that morning? Were they trying to get some? I mean, really, no one knew where the market was. Some platforms weren't even working. But what was the talk? What was, were you able to actually get some good buys in there? And were there orders that you think should have been filled but weren't?
I don't, we didn't see any panic on our desk, and certainly we're a relatively small sample, being we're an agency, a broker dealer desk, but we didn't see any panic. It was business as usual for us. Obviously, there was a lot of volatility, and could you have caught an ETF down 30%? No, we weren't buying those. Our customers weren't doing that. We were trading regular way, but it was the funny thing is it happened quickly, just like the flash crash. It was over in a few minutes. Right, that big plunge down was over within the first 5 or so 10 minutes. So in that respect, no, we really didn't see much activity there. In fact, more often than not, we're not usually trading around the opening that much. A lot of people don't trust the opening anymore. They don't trust what they see. They're tired of seeing a print go up, on the opening, and then the stock plunges, whether it's 50 cents or $1, and only to rip right back up again. People don't feel that price is very relevant anymore. So a lot of people are just waiting outside and wait for the stock to actually settle up a little bit.
And I always ask you about the IEX. How's that doing? The exchange that kind of to combat the high frequency trading. You doing a little bit more? How's the volume been on that?
Yeah, they're doing great. Actually, they just filed their application to become an exchange, so they would be one of those lit venues we were just talking about. Right now they're an ATS, so they operate outside of the quote. Although they do have a lit quote, but it's not part of the protected quote. That's a whole different story. But right now they did file as an exchange, and we actually just put our application in to become one of their members because we think it's going to be a tremendous exchange. Those guys, you remember we talked about, you said before, that we get it. Well, those guys get it. They understand the issues in the market, and what's interesting about their exchanges, they do have a diversity of participants. They do have so-called high-frequency market makers on their system. They do have traditional venues. They do have institutional investors, but you don't have the problems on there that you do with other dark pools or lit venues. They created a better model. And I think, other exchanges should be looking at them saying, wow, why are these guys so successful? What's going on here? They must be doing something right. Yeah, what they're doing is, fairness and transparency, like we've been arguing for years. They put it out there. This is what we do, guys. This is our model. Do you like it? And we find that when we're trading in there, we certainly are getting better fills. You certainly see less wiggle, as we call it, when prices are moving around for no apparent reason on other exchanges. So, yeah, we still have a great experience with them, and we think they're going to do well.
Are they selling memberships?
No, we're actually, as a member, we're a member of their ATS now. It's a wave-in process. You just become part of their exchange, just like any other exchange right now. You're not really, you on some of these exchanges they charge you a yearly fee. Others are free. I don't think IEX is going to have any fee attached to it. But you just wave in as an ATS member. We just, we're changing our application to become an exchange member.
Sorry, Joe, I just want to ask you something. Somebody's bringing up a point in our chat room. Spice is asking, and he says he's sick of having his stop losses hit and then only to see the stock rip the other way. He's obviously talking about the stop hunters out there. Do you think that there is stop hunting algos out there that are intentionally running stops and then taking them the other way, and that's kind of like the chop that you see intraday? Are you seeing that? Do you have institutional clients that complain about stuff like that?
No, I don't have any evidence to it. I don't have any proof to it. I'm sure a lot of people feel that way, and certainly it's a good cause. It's a concern, and it's something that I would hope that the regulators are looking into, but I really have very little faith in that because I don't think they do understand it. But I have heard from others that certain, these stops do sit at some of these, when you do a retail broker sends it out, that it may sit at an internalizing market maker, and they may know where the stops are. So I don't know. I mean, it's something that it needs to be investigated, certainly, but a lot of people feel that way. He's certainly not alone.
There needs to be more transparency there, that's for sure. I think, from my experience too, is if you're trading off the open, you said how you try to avoid maybe the first few minutes sometimes, because I think it's just a lack of liquidity at that point in time there too. Like sometimes you'll see Johnson & Johnson open with a 20-cent spread. I mean, intraday it's got a 1 penny spread, but if there's stops on the book, that can actually make it move the other direction too. So it might not even be stop hunting. It might just be the lack of liquidity that's causing these stops to get hit too. So it's a little bit scary just trading that opening 5 minutes.
Absolutely. The stop turns into a market order. And just like we talked about before with that ETF flash crash, those market orders hunt for bids. That's the first, if it's a sell order and it's hunting for a bid, where's the bid? It's going to hit what's down there. It doesn't know that it's down 3% or 5%. And so those are, dangerous. Obviously, we've always be careful. When you're using stop orders, have it convert to a limit order would be better than a market order. You certainly don't want to do that.
We've been on the line with Joe Saluzzi. He's partner and co-founder of Themis Trading, joining us here in Benzinga's pre-market prep. Dennis loves talking about market structure. I love learning about it. Thanks a lot, Joe. Great input as usual. We'll talk to you again soon.
Thanks, guys. Talk to you soon.